we are still quite cautiously bearish with all that rally that we saw, to be honest, in the last 2 months, which was very much investor driven and not fundamentally driven. So we still remain quite cautious on that factor.
When you say investor driven, you think that the reason for the closing out of shorts was financial and perhaps to do with liquidity rather than being a view on the change in what the value of a barrel of oil should be?
It was a change in view of what the barrel should be. I mean, that perceived view versus fundamental price, there was a big difference there. It was driven by both institutional investors and retail investors. If you look at the number of increased positions, net long positions for both Brent and WTI on the investor side using CFTC data, the number of positions up for Brent was close to 200 million barrels worth of contracts since January, early January. And for WTI, the same contracts were close to 100 million barrels. In the retail side, if you look at the US oil fund, even over there we had seen some increased positions which now have started to reduce, at least on the US oil front ETF side. But on the institutional investors, we are still seeing increased positions week on week, and that seems to still support oil prices, which, to be honest, is still not quite fundamentally driven according to us.
Are investors toying with oil producers at this point? You've got a big meeting coming up in mid-April in Doha, where investors now are giving those producers just a flavour of what it feels like to have a slightly firmer oil price again. If there is no deal done to freeze production at best, I mean, are investors even saying, well, maybe you need to see a cut delivered at this meeting, then the price could fall from here. Do you think this is just a flavour of what the future might hold, or investors are saying, well, pull the price back a little bit, you decide what you want to do?
More than investors giving them a flavor, I think investors slightly got overexcited with a couple of factors here. One was the OPEC, non-OPEC freeze meeting news, which was out there, which they believed was enough to balance the market. But two, in the second month of this year, we also start seeing US oil companies giving further capex reduction for the year and forward guidance on what production would be in 2016, which was year-on-year declining according to them. So all these factors really helped them take bullish bets starting almost earlier this year. And that has really supported. Now, of course, as I said, there's a big divergence between what positions they are taking based on a perceived price versus what the prices should be based on fundamentals. And if the Doha meeting comes up with absolutely no freeze cuts or no reason to believe that markets will be balanced towards the third quarter or fourth quarter of this year, then yes, of course, investors are likely to get out of it as soon as possible.
I wonder if we're going to be afflicted with the curse of sideways trade here. I mean, the trader's narrative tends to be, well, we're going to have upside or we're going to have downside. But we've rebounded from this 1.5-year slump in the crude price. Is there any reason at this point why we should imagine that the price would slip back to $25, $26 a barrel?
One reason to believe that prices could still go back down, whether it's 20 or 25, it really depends on the glut in the market. And we believe that the reason that could push the prices down would be if the global storages worldwide were to be tested. And that basically would mean that the economics of storing oil would move from onshore storage, as you all know, towards offshore storage, and a floating storage generally requires a much steeper contango to justify putting oil on the ships. And that would mean that prices could go down further. And if there was a chance for oil prices to go down further, it is, to be honest, in coming couple of months. If we go past second quarter, then the chances of a more sustainable support is in place.